In this video, we're going to talk about how to accrue warranty expense in the financial statements. So first of all, it's a good idea to have an understanding what warranty means. And basically, we're talking about some kind of guarantee that a firm is making when you buy the product, that there won't be any problems, it won't break, or if it does, they'll actually replace the components that broke, or they'll replace your computer, whatever it is that you purchased. So it's some kind of guarantee about the workmanship. So a firm here, as you might see, if they have a warranty, they might have some kind of liability associated with that, right? Because remember, a liability is basically an obligation to sacrifice some assets at some point in time. So when we have a warranty and we say, okay, you bought this computer, but if it breaks, we'll replace it. We'll give you another computer. Well, we know there's some kind of obligation here. So we have to determine, well, how do we account for this? How do we put this in the financial statements? How do we recognize this warranty or a possible liability? Well, basically, we treat it like a contingency, like a contingent loss. And if you remember from our discussion on contingencies, we know that we're going to accrue a loss contingency when it's both probable, that is the likelihood that we're going to incur a liability is probable, and then also when it's reasonably estimable. Reasonably estimable. So if we have no idea, we can't estimate what the amount of the liability is, then we're not going to accrue anything. In that case, if we don't meet these two conditions, what we're going to use for warranty expense is we're just going to use something called the cash basis, which is really simple, which is basically when there is that the defect or some kind of problem where the warranty needs to come into play. For example, customer buys a computer, it breaks, they send it back to us, we have to send them a new computer. We just go ahead and just debit, according to cash basis, we just debit warranty expense and then give them the new computer. So we just kind of do it as it happens. So defective product comes in, we make a journal entry. But it's a little different when it's probable and reasonably estimable, because then we can look forward to the future and say, okay, we know that we're going to have some warranty liability here. We can estimate it. So let's go ahead and accrue the liability before anyone actually sends in any defective products. And that's what we mean by accruing warranty expense. And now let's kind of work through an example so we can see how we would go about doing that. So let's return to our example of a computer firm, or a firm that sells computers. So let's say in January 2017, this firm sells 200 computers. Sells 200 computers for, let's say, $500 each. For $500 each. Okay, and then there's a 2-year warranty. So the firm is saying, look, if this computer breaks in the next 2 years, we'll replace it, we'll take care of it, we'll make you whole. So let's think, okay, well, what's the journal entry for this? Well, this should be easy review here, right? We've got 200 computers, we've got $500, so we're talking about $100,000. And so on January, let's just say this is January 1st. So on January 1st, we're going to have a debit, and let's say this was cash. This $500, everyone paid cash. So we're going to debit cash for $500. This is from the firm's perspective. The firm's going to debit cash for $500, and then they're going to credit sales, or excuse me, $500. $100,000. My apologies. So they're going to debit cash for $100,000. And they're going to credit sales for $100,000. And this is simply the 200 computers times $500 each, the sale price. But now we've got this 2-year warranty to think about. So now let's assume that it's probable that some of these computers are going to be returned, and that the firm can go ahead and estimate that. They can come out with some kind of reasonable estimate. So now we have to make a liability accrual here. We have to accrue a liability, and let's say that the firm decides to do it, as most firms do, at the end of the period. Let's say here it's the end of the year. They're going to make an adjusting journal entry, and they're going to have to accrue a liability here. But now the question is, well, how much? So the firm says, okay, well, we estimate, and this is where that reasonably estimable comes into play, estimate $50 in warranty expense per computer. So just on average, it's going to be $50 warranty expense, WE, per comp. Okay, so they're just estimating $50. So now we can say, okay, well, how do we actually map this into a journal entry? Well, let's think about it. So there's 200 computers, and they're estimating on average they're going to have an expense or a liability. So they're going to have to sacrifice some assets to the tune of $50 for each computer. So we just take that 50 and multiply it by 200, right? And that's what we have to accrue. So what do we have here? 50 times 200 is 10,000. So we're going to have warranty expense of $10,000. Okay, now we have to think about a couple things here. So we've got this warranty expense for $10,000, and now we have to say, okay, well, what was the actual returns? Remember, this is the end of the period here, so we've had a whole year. How much was actually returned? What was the actual warranties that were returned or that we had to give out in terms of computers? Let's say every time there was a broken computer, we sent out a new one. So we have to make a credit for this during this year, the actual, right? This is kind of our estimated, right? We know that at some point we're going to have an expense of $10,000, but during this actual year one, how many assets did we have to sacrifice as a result of this 2-year warranty? What was the actual that we had for year one? And so let's say that the inventory, this is like laptops that we replace the original computer with. Let's say that inventory ends up being something like $7,000. Okay, so now we've got where we've accrued this expense for $10,000. And then when we look at, now this is covering, all the warranty obligation we're going to have, right? Because remember, it's a 2-year warranty. But now for year one, the actual is we actually pay out or give out an inventory of $7,000. So now you see, well, we need a credit here for $3,000 to make this balance. And what is this? Well, we'll just call this warranty liability. Warranty liability. And so basically this is just saying, look, we haven't actually incurred, we've incurred a liability here, but we haven't actually paid out any inventory for this $3,000 yet, but we expect that we're going to in year 2, and so we're making this entry here right now for this warranty liability. And then so you say, okay, well, what happens in year 2 when this $3,000 comes to fruition, when we do have to send out another $3,000 in inventory? So let's just go ahead and let's make the next year's journal entry. So 12/31/18. So now we're going to reduce the warranty liability account to 0 because now the 2-year period is up. So this $3,000, if we picture a T account, right, we've got a credit balance and warranty liability of $3,000. So we debit that to bring it to 0 because we no longer have any warranty liability because now the 2-year period is up, right? But we had to give out inventory. Here we give out inventory of $7,000, but then we give out inventory of another $3,000, right? Remember this, we accrued the liability for it, but in year 1 we didn't actually give out the inventory for like the defective units. We didn't give out the new units yet because they haven't become defective until 2018. So now we credit inventory for $3,000, and our warranty liability account is basically zeroed out. And now we've given out all the inventory that we thought we were going to. But notice that we did a really good job matching because all the warranty expense, right, which is going to affect the income statement, that happened in 2017, which incidentally is the same year where we had the sales, right? So we matched our expense with the sales. So in terms of the income statement, we had really good matching here. Now, if we had not been able to reasonably estimate this, or it hadn't been probable for some reason we couldn't accrue the warranty expense and had to use cash basis, then what we would have had is basically we would have expensed $7,000 in year one, because that's what the actual returns were of defective products, right? This $7,000. We would have just expensed $7,000 in year one, and then we would have expensed $3,000 in year two, right? Instead of having all the expense up front matched with the sales, we would have spread it over the 2 periods as we actually had defective products come in. So you see that when we accrue the warranty expense, the warranty liability, it does a much better job matching the expense with the same period in which the sales occur that actually are going to lead to the liability.